Investing is often considered the best way to accumulate wealth over time. However, for most people, the journey to becoming financially secure starts with understanding the basics of building an investment portfolio. A well-structured investment portfolio helps you achieve financial goals while managing risk. In this step-by-step guide, we will walk you through how to create your first investment portfolio. Understanding investment basics. At its core, investing involves directing resources, your money, into assets with the expectation that they will generate a return. When you invest, you are essentially putting your money to work for you, aiming to grow it over time. There are many ways to invest, including stocks, bonds, real estate, mutual funds, exchange-traded funds, ETFs, and more. Before diving into specific investments, it's crucial to understand the basic principles behind them. The wealthiest individuals in the world have typically accumulated their wealth through successful investments. Let's begin by exploring the types of investments available to you. Assessing your financial situation. The first step in building your portfolio is to assess your current financial situation. This includes understanding your income, savings, liabilities, and any existing investments. You will also need to evaluate your financial goals, whether you are investing for retirement, buying a home, or building wealth over the long term. Start by establishing a budget that includes your monthly expenses and savings. This budget will help you determine how much you can afford to invest each month. Make sure that you have an emergency fund in place before committing to investments, as this fund will serve as a financial cushion in case of unexpected expenses. Setting investment goals. Setting clear investment goals is essential before you start building your portfolio. Investment goals are what will guide your asset allocation and the types of investments you choose. Your goals may be short-term, saving for a vacation or a new car, medium-term, saving for a down payment on a home, or long-term, retirement or funding your children's education. When setting your goals, it's important to consider your time horizon and risk tolerance. Time horizon refers to how long you plan to hold your investments before needing access to the funds. Risk tolerance, on the other hand, refers to your ability and willingness to withstand fluctuations in the value of your investments. Diversifying your portfolio. Diversification is one of the key strategies for reducing risk in your investment portfolio. It involves spreading your investments across different asset classes, industries, and geographical regions to minimize the impact of any single investment's poor performance. By diversifying your portfolio, you reduce the risk of losing money if one type of investment performs poorly. The goal is to ensure that your portfolio contains a mix of assets that behave differently under various market conditions. This can include a combination of stocks, bonds, real estate, and cash. Choosing the right asset allocation. Asset allocation refers to how you divide your investments across different asset classes, such as equities, stocks, fixed income, bonds, and cash. The right asset allocation depends on several factors, including your investment goals, time horizon, and risk tolerance. For example, if you are younger and investing for retirement, you may want to allocate a larger portion of your portfolio to stocks, which tend to offer higher returns over the long term, albeit with higher risk. Conversely, if you are closer to retirement, you may prefer a more conservative allocation with a higher percentage of bonds and cash to preserve capital. A general rule of thumb for asset allocation is that the percentage of stocks in your portfolio should equal 100 minus your age. So, if you are 30 years old, you might allocate 70% of your portfolio to stocks and 30% to bonds and cash. This is just a guideline, and you should adjust your allocation based on your individual circumstances. Selecting individual investments. Once you have determined your asset allocation, the next step is to choose individual investments within each asset class. The two most common types of investments for beginners are stocks and bonds. Stocks. Stocks represent ownership in a company and can provide both capital appreciation, increase in value, and dividends, regular payments to shareholders. Investing in stocks offers the potential for high returns, but it also comes with significant risk, as stock prices can fluctuate widely. As a stockholder, you earn money through dividends and capital gains. Dividends are periodic payments made to shareholders based on the company's profits. The size of the dividend depends on the company's financial performance. Capital gains occur when you sell your stocks for a higher price than you initially paid for them. Bonds. Bonds are fixed-income securities that allow investors to lend money to a corporation or government entity in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks because they provide a steady stream of income, but they tend to offer lower returns as well. The key components of bonds include the coupon rate, the interest rate paid to bondholders, maturity date when the bond will mature and the principal will be repaid, and par value, the amount paid back to the bondholder at maturity. Bonds can be a good option for those seeking a stable income stream and less volatility compared to stocks. Exchange-traded funds, ETFs. ETFs are a type of investment fund that holds a collection of assets, such as stocks or bonds, and trades on stock exchanges like individual stocks. ETFs offer a simple way to diversify your portfolio, as they provide exposure to a broad range of assets in a single investment. There are many types of ETFs, including those that track indices, sectors, commodities, and bonds. They are a popular choice for investors who want to achieve broad market exposure without having to pick individual stocks or bonds. Mutual funds. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. They are managed by professional portfolio managers, making them a good option for those who prefer a hands-off approach to investing. Mutual funds come in many forms, including equity funds, bond funds, index funds, and balanced funds. Each type of fund has its own risk and return profile, so it's important to choose one that aligns with your investment goals. Managing your investment portfolio. After building your portfolio, it's important to monitor and manage your investments over time. Regularly reviewing your portfolio helps you ensure that your asset allocation remains in line with your goals and risk tolerance. Rebalancing is a key aspect of portfolio management. Over time, some of your investments may outperform others, causing your asset allocation to drift away from your target. Rebalancing involves selling some of your overperforming assets and buying more of the underperforming ones to restore your desired allocation. It's also important to stay informed about market trends and economic conditions that may affect your investments. This will allow you to make informed decisions about when to adjust your portfolio. However, avoid making emotional decisions based on short-term market fluctuations. Successful investing is about staying the course and focusing on long-term goals. The role of tax considerations. When building an investment portfolio, it's important to consider the tax implications of your investments. Taxes can significantly impact the returns you earn on your investments. In many countries, dividends and capital gains are subject to taxation. One way to minimize taxes is to take advantage of tax-advantaged accounts, such as individual retirement accounts, IRAs, or 401(k)s. If available in your country, these accounts allow your investments to grow tax-deferred or tax-free, depending on the type of account. Tax-efficient investing strategies can also help minimize the impact of taxes on your portfolio. For example, you can invest in tax-efficient funds, such as index funds or ETFs, which tend to have lower turnover and generate fewer taxable events than actively managed funds. Understanding market psychology. Market psychology refers to the emotions and behaviors of investors that drive market trends. It plays a significant role in how financial markets function. The fear and greed of investors can cause market volatility, leading to price swings that may not be justified by fundamentals. As an investor, it's important to stay grounded and avoid making decisions based on short-term market movements. Successful investing requires patience, discipline, and the ability to stay focused on long-term goals rather than reacting to emotional impulses. Tracking your investment performance. Tracking your investment performance is essential for understanding how well your portfolio is meeting your goals. Use performance metrics such as total return, which includes both capital appreciation and income earned, to evaluate your portfolio's performance over time. You can also compare your portfolio's performance to relevant benchmarks, such as the S&P 500 for U.S. stocks or a bond index for fixed income investments. This helps you determine if your investments are performing well relative to the broader market. Building your first investment portfolio is an exciting and important step toward achieving financial security. By understanding the basics of investing, assessing your financial situation, setting clear goals, and diversifying your assets, You can create a portfolio that aligns with your risk tolerance and long-term objectives. Remember, investing is a marathon, not a sprint. It takes time, discipline, and a well-thought-out strategy to see your investments grow. Start with a solid foundation, stay informed, and continue to refine your portfolio as your financial goals evolve. With careful planning and patience, your investment portfolio can help you achieve financial independence and create long-term wealth. Happy investing!